Adam, thanks very much. And we're going to invite the rest of the crowd up, come on up here to talk about real estate crowdfunding for investors. Amy Wan will be the moderator for this. We'll invite Clay Malcolm, Matt Schuberg, Jalen Hellman, and Adam, of course, will join the group, and we can continue with the questions and answers, but they have some great things to say. If they'd come on up, we'll get started with the next segment right here. Thanks very much. Appreciate it.
Thank you. We have a booth outside, and feel free to come by and chat with me or anyone on my team. If you would like any more information, we're here.
Yeah, they're in the booth next door, right next door. Come on up. Yeah, we didn't get them. Hi, Amy. This microphone's for you.
Oh, thank you. Perfect. All right, well, it looks like we already have all the people interested in real estate crowdfunding in the room. Well, we look forward to giving you an exciting panel on real estate crowdfunding with a specific emphasis towards investors as opposed to issuers. So we have a lot of really great panelists up here today, and Adam has returned. Fantastic. So why don't we just go down the line very quickly. You guys can tell us your name, a little bit about your company, and then to the extent that you run a real estate crowdfunding platform, go ahead and tell us about why and how your platform is different from the other real estate crowdfunding platforms out there.
Sure. So,
does it work?
There we go. Hello?
No? Do you want to try this one?
Does this one work?
Technical difficulties. Give us a moment.
Hello? Oh, there we go. Okay. So my name is Matt Schuberg. I'm the co-founder and...
Sorry.
Now it's working. I'm the co-founder and CEO of RealCap. What makes us different, our focus is on the self-storage niche. So we've found a lot of success in that industry. We've been in other asset classes, but we found self-storage to be a great way to kind of differentiate ourselves, and that's kind of how we approach real estate crowdfunding. So we found crowdfunding as a great way to kind of just scale our business. We see a lot of opportunity in the space, and so through crowdfunding, we're able to raise enough capital to acquire the properties we're seeing. So,
Great. Jillian?
I'm Jillian Hellman, and I'm the CEO of Realty Mogul. We're probably one of the oldest real estate crowdfunding companies. We were founded in 2012. We've made investments in over $1 billion worth of real estate. Investors on our platform have invested over $300 million. So I think we're probably a little bit different in just size and scale of the types of transactions that we've done. We focus exclusively on commercial real estate, so apartment buildings, office, self-storage, industrial. We don't do any hospitality. We don't do any ground-up development. We're really cash flow investors. So we're looking to get cash out of our system as much as we're looking to get cash into our system. We've done over $65 million of distributions back out to investors, which is a really important number for us. I remember starting the business and saying to our team, you know, we're going to generate $100 million in passive income to investors, and at the time it was a total pipe dream. And today we're more than halfway there, so it's really exciting to see. We invest in both debt and equity in commercial real estate. We're probably best known in the markets for our joint venture equity business. You know, investing joint venture equity alongside great real estate companies. We don't acquire any real estate on our own, so we're not an acquisitions company. We're really a financing company, where a commercial real estate company will come to us and they'll say, we've got this great deal, you know, it's an apartment building in Texas, or it's a retail shopping center in California, or a self-storage facility in Florida, or whatever the property may be. And we'll underwrite that transaction internally. And then if it passes our screening, we will put that up on our website for our investors to invest in. We have 135,000 investors on the platform today. I was sitting in on the panel about marketing earlier, and you know, it's really hard to acquire these investors. You really acquire them one at a time, and you build relationships and you build trust with them one at a time, even though you're running and building an online platform. So we feel very, very strongly that we should be regulated. So one of the other ways that we're different as far as a crowdfunding platform is we work through a broker-dealer, and we also own and operate 2 investment advisors. So we choose to be regulated. We are highly regulated. We have licensed investment registered representatives who are on the phones with our investors if they have questions, which makes us a little bit different and makes it so that our arms are tied a little bit in what we can and cannot say, but it means that when we say something, it's true, right? Because if not, I'm going to go to jail, and I don't want to do that. So had a lot of fun building our company, have had a lot of fun investing in real estate, and yeah, it's Realty Mogul.
Hi, everyone. I'm Clay Malcolm, Chief Business Development Officer at New Direction IRA. And I come at this from a little bit different perspective in as much as we are a provider of self-directed IRAs. And so a lot of what we're doing here is making sure that the collaboration between these types of investments and the tax advantages of an IRA, that marriage can take place. We do a lot of technology kind of collaboration in terms of we would love to have the day when somebody can go to an investment platform, and this happens to some extent now, goes to an investment platform, and when they choose their investment bank account that they're going to make from which they're going to make the investment, that their IRA is one of those as well. And so we started out at New Direction. We were founded by a CPA and a real estate investor, so we've always had kind of a soft spot for that type of investment. And as a self-directed IRA provider, democratization of investment is part of our fabric, and so it's really nice for us to be here amongst people who have that same kind of vision.
For people who just walked in the room and didn't hear me speak a few minutes ago, my name is Adam Kaufman. I am the co-founder and managing director of Arbor Crowd. Arbor Crowd is part of the Arbor family of companies. Arbor Realty Trust, the publicly traded real estate investment trust. AMAC, Arbor Management Acquisitions Company, is our private equity shop. And we are a crowdfunding company that focuses on equity, and we target accredited investors. We're a relatively new company. We started about a year and a half ago. We launched our first deal about a year ago. We've successfully completed 4 deals. And what we aim to do is find the best deals on the market through our relationship of over 30 years of experience on the Arbor Realty Trust side, and bring that over and share in those investment opportunities with a whole new class of investors, retail investors.
Great, thank you so much, guys. And last but not least, my name is Amy Wan. I'm CEO of Bootstrap Legal. We are a legal technology company that automates the drafting of the legal documents that real estate syndicators and crowdfunders need to go raise capital. Previously, I was general counsel at Patch of Land, which is a real estate crowdfunding platform. I was a partner at Crowdfunding Lawyers, or Trowbridge Sidoti, so have been in this industry for a little while. So I remember back in 2014 when I joined the real estate crowdfunding industry. At that time, it just seemed like there was so much to learn in terms of learning how does someone, get into real estate investing or real estate crowdfunding investing. What should an investor know? It just seems like there's so much information out there. BiggerPockets has hundreds of thousands of threads. So when it comes to real estate investing or real estate crowdfunding investing, and feel free to answer as you please, but what really should people be looking at? Like, what's a simple way to kind of approach this behemoth of information?
Well, I'll go ahead and start and just say that I think it starts with your existing real estate team and the things that you know best. I know, always coming from an IRA perspective, for me, usually what we're doing is somebody's taking a strategy that they already use with their personal funds, whether it's fix and flips or fix and hold or equity financing or any of those things that are available, and then they're just grafting that into the tax-advantaged account. And more often than not, they start with something that's familiar to them or that their friend or financial team has an expertise in. So once you have that, then that starts to build a kernel where you can expand your knowledge into the rest of the real estate realm.
Yeah, I agree. I think biggerpockets.com is a great resource for people. That's actually kind of how I got started. I met my business partner on there, so definitely a great resource to use. The thing I like about crowdfunding, though, is that you don't necessarily have to understand the investment right away to get involved. So I think it's a great way for beginning investors who are interested in real estate to kind of get their feet wet, and they have a passive investment where they can follow along with what's going on with what properties the company is acquiring, how they manage it, and with a lot of companies, you're able to reach out directly to them, and if you have any questions or anything like that, they'll be able to answer them for you. So I think it's a great way to get started and learn the business, and then from there on your own, either venture out on your own if you'd like to do that, or if you prefer staying passive, just sticking with crowdfunding.
Yeah, prior to starting Realty Mogul, my career was in wealth management, and I think it's the same concept as wealth management. The question to ask yourself is, what do I want, right? What am I trying to accomplish? Maybe it's not even real estate, but what am I trying to accomplish? Do I need cash flow, right? Am I looking for income? Do I want money every month that I can live off of? Do I not really care about cash flow, but I really care about, a big pop in 5 years or in 7 years? I think another big question around real estate crowdfunding to ask yourself is, do I need liquidity, right? Do I need to be able to liquidate that transaction in 2 days or 5 days or 10 days? If you need liquidity, real estate crowdfunding is probably not a very good investment option for you. It should really be thought of as sort of the illiquid piece of your portfolio. And then the other question is around, do I want to be in a single property? Do I want to take single property risk, or do I want to be in a diversified pool or a diversified fund where I have exposure to a bunch of different types of commercial real estate? So I think trying to figure out what is it that you're actually trying to accomplish, and then building a strategy backwards from that is a really good way to do it. But probably most importantly, as we've learned at our company, we've done 150 transactions plus or minus. And as much time as we spend underwriting the real estate, understanding if the market can support the rental income, understanding where the jobs are and why people are living in that market, and if the jobs are going to stay, at the end of the day, I think real estate is more about people than it is about real estate. And we've done, hundreds of partnerships now and identified that. And I think that it's using a crowdfunding platform that you can gain trust in, right? Building a relationship with someone there, believing in the executive team, believing in the leadership team, believing in the CEO. I think people is really, really critical, even though it's an online platform.
So to build on what Jillian's saying, I completely agree. I think it's about people and it's about trust. And that's why it's a partnership at the end of the day. So if you're going to invest based on your preferences in an individual property, you need to believe in the depth and expertise of the sponsor you're doing business with. Not the person that's connecting you per se, but what's their experience? Are you being presented with their experience? Do you understand it, and do you believe in their execution? And ultimately, if you want to go through with that investment, you can do it one time, you can do it on the next property or on the next offering, and you can diversify your portfolio across many different real estate investment opportunities.
So kind of building on what you two were just saying, it really comes down to people. I think typically when people invest in any sort of real estate deal, like you said, it comes down to the sponsor and it comes down to the property, to the extent that there is a property and it's not a blind pool, right? So for the platforms up here, can you tell me a little bit about what you guys look for when you are evaluating all the deals that come through your pipeline? Do you go ahead and you list every deal that comes through? Do you personally curate them? Do you have, some internal technology that curates them? Or is this still very much like you get on the phone and you talk to the sponsor, and how do you ascertain that they are the real deal?
Yeah, so we're highly curated. We've had 30,000 people apply on our website to get financing. It's astonishing to me. I remember when we started the company and we were talking to we're venture capital backed. We were talking to our venture capitalists and we said, people are going to apply online and people are going to invest online. And there was a ton of skepticism from a lot of people. This is back 2012, 5 years ago, before any of this had really happened or gotten big. So we've had 30,000 people apply online for financing. We have given financing to 65. So 65 out of 30,000 applications we've actually done business with. So, sometimes there's this fallacy around crowdfunding that it's really easy to raise capital and you can go out and you can raise capital. It's just not the truth, at least on our platform. We're looking, when we're investing equity with a real estate company, we're looking for a company that's done around $100 million in transactions. So they've already raised friends and family money. They've already got a track record. We're digging into their track record. We're understanding what transactions have they done. Have they done a transaction like this in that market, right? Have they done an apartment building in Portland, for example, or is all their experience in, self-storage in Minnesota, right? We wouldn't want to work with that company if they were doing a completely new business plan that they'd never done before. So we operate a highly curated platform. We have a team that's on the phone with these folks. The getting from 30,000 to 65, a lot of that is automated. But once we get down to the 200 and then go from 200 to 65, that's very manual, right? We're building relationships with these real estate companies. We'll invest 5, 10, 15, 20 times with these same real estate companies that we get to know and understand their business plans. We go and walk every property that we invest in. So someone from my team is actually boots on the ground in every property, and that's part of the due diligence that we do on behalf of the investors that are investing with us through Realty Mogul. We run background checks, we run criminal checks, we run credit checks on our sponsorship, we run reference checks, so we're calling on banks, we're calling on brokers, we actually have documented forms of reference checks. So we do a tremendous amount of work on these real estate companies because they're critical, right? When you think about what happens in a downturn, really great real estate companies can get you out of a really hairy situation. Not so great real estate companies can't get you out of a hairy situation, same property, right? And that's the reality of real estate investing. So we do a tremendous amount of diligence, and we have a very small number of real estate companies that make it through to the bottom of the funnel that we actually offer up their transactions.
Yeah, oh, I'm sorry. I was going to say, this is where, we're a lot different than Jillian's company, where we're technically a platform, but we don't have the kind of quantity that they offer on their platform because we're doing the deals ourselves. So I definitely understand the platform aspect of it. There's that side, but we took the approach of keeping control of all the investments. So my partner and I personally are we're vetting every deal. We're doing the underwriting. We're managing the properties. If we're not managing them ourselves, we're evaluating, the third-party property management company that we're using. So we like that control aspect. So the amount of deals that we have on our platform is definitely less, but we're able to keep control, and we think we're able to find better deals that way, and we don't have to worry about vetting the companies also.
So really, for your platform, people are investing in you.
Right, exactly. And we like that aspect of it, the personal touch. It totally depends what you're looking for, and again, it comes down to the investor, what their desires are. But so I like that there's the options out there for everyone. I think you can find exactly what you're looking for.
Adam, do you have anything to add?
Yeah, our model is different because the Arbor Realty Trust side of our family of companies always facilitates the debt on each transaction that we present to the crowd. So it goes through the entire debt process. It secures its loan before it even faces us on the crowd side. And that's an enormous process with enormous due diligence. Once it comes over to us, we're looking how many loans have we already closed with this borrower or this future sponsor? Do we believe in their track record and their success? And we then go from there before we launch it onto the platform. And sometimes our private equity shop, AMAC, is also in the equity. So not only are we facilitating the debt, but we're also in the equity on our private equity side and bringing in the crowd.
So Clay, turning to you for a second, I know SCRAs are a popular way for people to actually invest in real estate crowdfunding. I've definitely seen it a lot. But why would an investor go and open an SCRA account? What are the benefits?
Sure. Well, I think the most common model is somebody looks at their old 401k or their IRA, and once you've made the contributions to that tax-advantaged account, your job as the account holder is to get that money to make the most money. That's why you open the account, because of the tax-deferred earnings. And so the most common thing is that somebody looks at that and says, I do my investing in real estate or in crowdfunding or cryptocurrency or whatever it is, and I know that marketplace and I know what I can make as returns, and my tax advantage money is not making that. And so that's really the motivation to then do a transfer or a rollover to a provider that knows how to handle that kind of thing. And again, to continue their investment expertise, but adding the tax advantages. So that's the usual thing. Somebody has a tax advantage money, they do a transfer or rollover, and then they tell us what they want to invest in, and we help them achieve that.
And to add to that, I think, to help Clay out here, I think retirement funds are absolutely perfect for crowdfunding or real estate in general. Just as Jillian mentioned, it's not a liquid investment, and retirement funds you obviously can't touch for a long time. So there's a lot of excess returns you can get through real estate, a lot of tax benefits, things like that. So to me, that's a great avenue for people. Maybe they don't have a lot saved up, but they have a lot in their IRA that they're not really doing much with, or it's in the stock market with a lot of volatility that they don't appreciate or can stand as well. So I think that's a great way to try to get better returns and put that money to better use for you.
So another question for you. There's this new thing that's come around, in the last, certainly the last half year, I guess. It's called the Department of Labor fiduciary rules. And I know there's been a lot of talk about that in the investment industry. Can you help us break down very briefly what this means, and does it affect anything that's happening up here? Does it affect real estate crowdfunding at all?
Well, I think it has the ability to affect everything. It just kind of depends on what the fallout of it is. So I think the general idea is fair play and fair disclosure and things like that. So one of the things that we've gotten into is we always kind of lived in that space because we don't give any advice, so we're not considered fiduciaries. But one of the things that we're trying to do is help advisors and platforms that want to also stay kind of clear of that, unless they want to enter into that arena, by housing the funds and things like that. So it gives them a little bit of a step away from being considered a fiduciary. So I do think it's a choice. One of the things that we're seeing now is that the advisory business is changing some, and you may be able to chime in on this. And people are choosing, okay, can I accommodate the fiduciary rule? Will my billing change? How do I accommodate this? And one of the things that's also shaking up, I think, is the way that people and the assets that people are advising investors to get into. So I do think that there's a possibility for a lot of wins here. The extra reporting and the financial burden that some advisors are assuming is going to happen, that may very well happen, and that's a little bit outside of our realm, but I do think it could, trickle down to pretty much everything we do. But I think all of us stopped at that moment and said, okay, well, do I fall inside the fiduciary rule or fall outside? And if so, how do I declare my position in that regard?
So I want to talk a little bit about niche platforms, or platforms that concentrate in some niche space for a second. So Jillian, Realty Mogul was one of the first real estate crowdfunding companies that went ahead and did a Reg A Plus. And what that means for those of you who might not know about Reg A Plus, it means that they can accept investments from non-accredited investors. So you don't have to be rich, you don't have to have that high net worth. Why did you decide to take that route, and how has that been different from serving the accredited investor market?
Sure. So just a little bit of background. We have two ways that you can invest with us. One is through our real estate investment trusts, and those are diversified pools of investments. The other way is through private placements, where you're investing in a specific property, so an apartment building, office building, shopping center, et cetera. The private placements are limited to just accredited investors, and the REITs are accessible by anybody, either accredited investors or non-accredited investors. Today we have two REITs. One is an income REIT, where we're really focused on generating income for investors. We've done 12 months of 8% consecutive annualized distributions. So we've been paying 8% on an annualized basis, and we pay monthly in our income REIT. And then our second REIT is a multifamily equity REIT. So you're investing in a diversified pool of multifamily apartment buildings where you're investing in equity. And the reason that we did it was multifold. Number one, we actually had a bunch of accredited investors saying to us, I don't want to pick and choose all these individual properties. I really just want to give you $100,000 or $250,000 or $1 million, and I want you to diversify it. They want to be truly passive. There's a spectrum of investments where you're active, you're acquiring properties, maybe you're fixing them up, you're flipping them. You're passive, where you're picking and choosing the investments that you're in, and maybe you're hyper passive or super passive, where you're making one investment and then you're hiring someone else to make all the investment decisions. So for those accredited investors who kept telling us, I really just want to give you the money and I want to sort of set it and forget it, you diversify it for me, you make investments in real estate for me, and I want a broader pool. So that was one of the reasons that we launched the REITs. Another reason that we launched was because we had north of 100,000 non-accredited investors in our database who wanted access to product. When they came online on our website, we pretty much said to them, we're sorry, but we can't sell you anything, right? We can't provide you anything. And now we can. So it was kind of a multifold decision around accredited investors wanting diversification and wanting to set it and forget it and not have to pick and choose each individual property. And then also non-accredited investors. And our REITs are managed by an investment advisor. So our investment advisor works on behalf of those REITs to make investment decisions And then those investors invest into those REITs. So it's really more of a set it and forget it strategy, much more passive than picking and choosing individual properties. But there's still a lot of accredited investors who want to pick and choose individual properties. They want to dive into the details of each individual property. And one of the concerns I think people thought that there was going to be in the REITs was that they wouldn't understand all of the individual assets in the REIT. And what we've done is we've made that super transparent. So if you go to our website and you look at the assets in our income REIT, you're going to be able to actually dive deep into each individual transaction that we've acquired to date, right, or made an investment in to date. Same thing on the equity REIT. So we've kind of married the best of both worlds where investors in the REITs don't have to make individual decisions, but they can still dive and do due diligence on the transactions that we've acquired to date.
So how is a Reg A Plus REIT different from just, one of the other REITs out there, whether they're private or they're, publicly traded?
So our REIT is a public REIT. We're subject to public company reporting. We're subject to audits. There's a lot of regulatory burden, if you will, in the REIT that we offer, but we're not traded. So we're not traded on a public exchange. There's no ability to buy or sell securities for the first year. There's called a 1-year lockout. You can actually sell out of our REIT after the first year, assuming that there is somebody to sell to, right? And we've got investors coming in the REIT, investors coming out of the REIT, so we can help facilitate that. But it's really an illiquid product, right? There's no guarantees about that. And despite the fact that you can buy in and out of our REIT, I'm really transparent with investors, and I say, look, if you're looking for something that's liquid, you shouldn't be in a non-traded anything, right? You shouldn't be in a private placement anything, and these are private securities. So we are public, subject to public company reporting. We're not traded, so it's not easy to get in and out the way that you can. We look at it as a really good vehicle for investors who don't want stock market volatility. So you don't want, these ups and downs based on the stock market, but you still want diversified exposure to commercial real estate. That's sort of the right investor for someone in the REIT, and you have a long time horizon, right? We take retirement assets into the REITs as well. So we've worked with some retirement companies to take retirement assets, because I agree it's a really good vehicle if you don't need that money for, years and years and years.
Yeah. So let's talk about asset class for a second. I think probably the most common asset class that you typically see on the different real estate crowdfunding platforms is either multifamily on the equity side and just small residential fix and flip debt deals, right? You are doing something a little bit different though. You're in the self-storage space. Why did you decide to be in the self-storage space, and how is it different?
Sure. So self-storage, it's kind of one of those assets that's kind of boring, and I think a lot of people overlook it because you drive past them all the time. You don't even notice them. So what we found, we were investing in all asset classes, and what we came to realize was self-storage is a lot easier to manage, and it's just really convenient for us. We didn't see nearly as much competition. There's a lot of mom and pop owners out there who don't really know how to run these. They inherited these properties, or they're just looking to retire. They don't want to manage it anymore. So there's a lot of deals to be found out there. And with all the competition, especially in this area, in multifamily and other commercial asset classes, we thought it was a great way to kind of differentiate ourselves. And along with Realty Mogul, we love cash flowing assets. And to us, self-storage is just a cash cow. So that's kind of what we view, why we picked it and how we view it differently. So just more opportunity we saw, at least right now. So
we've heard self-storage, we've heard multifamily. I think there's a lot of, there's definitely residential, right? Something I haven't seen a lot of is, for example, raw land or ground up construction, or I think I've seen some hospitality deals, but not too many. Why is that? Any thoughts?
I think for us, we want to limit the risk that our investors have exposure to. Our reputation's on the line, even though we're not the real estate company that's acquiring these transactions. There's a lot of risk in raw land. There's a lot of risk in ground up development. There's a lot of potential return, but I'd rather kick off a more realistic return with a better risk adjustment than invest in raw land personally.
Yeah, definitely risk is a huge factor there, and I think it's just a lot easier to explain real estate in general compared to the entire development process, adding that to the investor, especially if they're just getting into real estate. I think there's a lot more steps involved, and yeah, I'd say risk is definitely the number one thing though.
And to add on risk, I think, crowdfunding in the real estate arena is a fairly new concept. And if we were to take on this risk and things were to go south, we would be facing a lot of headaches and a lot of nightmares, especially from a retail investor that's really leaning on you to provide them with the education and transparency into each transaction. So, obviously, historically, multifamily has been, offered the best risk-adjusted returns, and I think that's why a lot of people stick there. It's also the bread and butter of where people want to live, and workforce housing specifically, people need to live.
So Jillian, earlier you talked about the different types of investors from most passive to least passive, right? Could you guys explain to me, at least within the context of real estate crowdfunding, how much control should an investor in a real estate crowdfunding deal feel like they have? And I know the answer might vary between debt deals and equity deals and whether you're part of a single asset deal or an entire fund, but generally how much control does an investor have, if any?
Sure. I think, for us, we structure each deal differently. And we look at the crowd as passive investors, and they have rights on certain major decisions. But to go back to what I said, that's why it's really important to have faith in the sponsor and his or her execution, and also to make sure that your interests are aligned, where they have equity in the transaction as well, and they want the property to go do well and perform well the same way the crowd does.
Yeah, I think as an individual investor investing in a crowdfunding transaction, you should expect to have zero control. You can do nothing, you can say as much as you want, but you can't do anything as an individual investor. As a collective group and a collective whole of investors, we have collective bargaining rights. So we negotiate a lot of rights on behalf of our investors, and we have an asset management team that will execute against those rights if we need to. So for example, if our crowd is investing, typically more than 70% of the equity in a transaction, we will have the ability to sell that property. We will have the ability to approve expenditures over $50,000. We will have the ability to kick out the property manager. We'll have a lot of rights that we get as a result of kind of collective bargaining, but as a single individual investor, you should expect to have no rights. And if you want rights, I don't think real estate crowdfunding is the right place to be investing, because you're typically investing a smaller dollar amount, right? If you're investing $100,000 in a transaction, you're not typically going to get rights. If you're collectively investing $4 million in a transaction, the way that we do as a collective institution, you're going to get a lot of rights. We just invested $5.7 million in equity in an apartment building in Dallas, and we have every right under the sun. We can kick out, the operating partner if they do something. If they sneeze the wrong way, I can kick them out, right? Now, I don't have any intention of kicking them out. I don't want to run that property, but the reality of the situation is that if we need to, we're going to, right? Because at the end of the day, we live and breathe by our investors, and we're alive for our investors. So I think that those collective bargaining rights are really, really important. And I spend personally a lot of my time on legal, which is impactful to our business, because I see a lot of other crowdfunding companies that will just sign on the dotted lines of operating agreements of real estate companies without negotiating them. And I think one of the greatest powers that you have investing through the crowd is the collective bargaining, because as an individual, you really get zero rights.
Great. Clay, another question for you. So having represented issuers on both the crowdfunding platform side and, as an attorney for, real estate syndication deals, one question that I often have seen or get is, what is the closing process when you're dealing with an SDRA? Even when I think you're, if someone's like investing through an SDRA on a platform, they can click, but there's still a lot of manual process, right? And I've seen all different kinds of rules. Like there's some SDRA companies that are like, oh, we need the original documents and it has to be in blue ink. You need to FedEx them to us. Like, there's all these different processes. Can you clarify a little bit, like what the process actually is, and why it's so manual?
Well, there are a few tentacles to that question, but I'll try to go down the middle here. So I think one of the things that you encounter is that there are IRS rules, and then there are IRA provider rules, right? So the IRS rules are actually pretty general and broad, and then each business builds their business model around those rules. So for instance, the key parts of the custodial entity of an IRA is that they have control of the assets, and that they are able to give a full accounting of what's happened with those assets to the IRS should that be necessary. So one of the things that you'll find is that people will sometimes, providers, IRA providers will sometimes overprotect themselves with their business practices. That's not an IRS rule. It's actually a business practice rule. So the things that you're looking for is somebody who does have control of the assets and the documentation of that, and that they feel like they've satisfied their role as the custodial entity for the IRS. So one of the things that I'll draw your attention to is that a lot of providers, in order to protect themselves, will ask for wedding signatures, and they will also, say every time you pull the trigger on a new transaction, even if it's with the same platform, you need to triangulate that paperwork through the IRA provider. And that's very common. It's traditionally, the idea is the IRA provider is the signer for the IRA, not the account holder. But it is possible also to set up a pre-approved pool of money, for instance, in one of the crowd investing sites, and then have each transaction be not require that new round of paperwork to come through the IRA provider. So there are new interpretations of the way that the rules are complied with, and there's also the technology part, right? So there's always this question about, do you accept e-signatures? Will you embed your forms on, speaking of the IRA providers, will you embed your forms in an electronic format and accept those? And I think all of it is, there's a CYA element to it, of course. We're trying to make sure that your IRA is documented properly. You want to make sure that's the case too, in case you get audited. But I do think that that's evolving. One of the big gaps for us was, it was so funny, people were watching ads on TV of somebody taking a picture of a check and it being deposited in their bank account, and then they come to us and we're starting to ask them to fill out paper forms and give us 2 copies and stuff like that. People were freaking out. So the last 5 years or so has really seen a revolution in technology, and hopefully that will catch up to where accepted forms of the IRA holder giving their permission to do something with their money will evolve into a place where it's more convenient.
And to add on to that, when does having an SCRA account make things different than, for example, personally investing your funds? Like, does it change the accreditation rules at all, or does the due diligence criteria change? What changes, if anything?
Yeah, it's a good question. The accreditation part of it, I'll just say that the IRA's accreditation follows the person at this point. Now, that's a little bit of a non sequitur to some extent, but if the individual who is the account holder is considered accredited, so is the IRA. So we don't have any specifically different accreditation. The due diligence process is really very similar. When it comes to a self-directed IRA, it's the account holder it's their due diligence process that needs to be satisfied, very similar to a way that you would individually. Now, that doesn't mean that you can't get help or professional advice or, all that kind of thing. Bring your financial team, absolutely, but where the rubber hits the road on the due diligence is the account holder or the investor. So that's similar.
Got it. All right, I have a juicy question for you guys. Fees. What are your fees? What should investors expect in terms of fees that they should be paying to the platforms or the sponsors?
We going down the line here?
Whatever you guys want.
So our fee, what we charge is we charge 1% up front, and that's to cover, marketing and putting the fund together and everything. And then we have a 1% yearly management fee since we're managing the properties ourselves. So, that's covering all of our operating expenses, things like that. And then we also, what we do is we invest personally in our deals, and we retain 20% ownership in each property that we acquire, and investors own the other 80%. So that's kind of how we structure it. We hope to make the majority of our profits through that 20%, along with our investors, through appreciation. And the other fees are hopefully just to cover our costs to get the fund together and everything.
Yeah, we're similar. We charge an origination fee and then an asset management fee. So our origination fee depends on the product, whether it's debt or equity, but it's typically between 1% and 3%, and that's charged to the real estate company up front. And then our asset management fees are typically 1 to 1.25% on an annual basis to the investor.
I think fees are a pretty sensitive topic for people in general, and that's why we really come out ahead of it. We charge really standard real estate fees that are disclosed within each deal's transaction, But they, for example, they're different. So our latest transaction, we had a 1% acquisition fee, half a point for an asset under management fee, 1% disposition fee, and 3/4 of a point for a refinance fee.
I'll weigh in too. So self-directed IRA companies all bill differently. They're allowed to do that. We bill for our bookkeeping labor, basically, so we have a fee for opening an account, a transaction fee, so on and so forth. All of that stuff is disclosed. One of the things that I think that has always been frustrating for folks who want to do self-directed IRAs is that it's usually not comparing apples to apples from a customer service standpoint, from a technology standpoint, from a fees standpoint. So I feel your pain, but you should at least get disclosure of whatever it is that what they're doing, how they're charging you, because it's, in our case, it's not a percentage and that kind of thing, but everybody's going to build their own business model, so just be aware of that.
I think just to add on to the fees, I think it's really important to make sure that the fees are presented to you up front, and you don't have to do a lot of work to read the fine lines to figure out what fees kick in at what point in time. A lot of companies offer a sliding scale of fees, and there's nothing to stop them from taking the 3% when they say 1 to 3. So I think you really need to do your due diligence and do your calculations, and that should be easy for you to do if you're working with the right company.
So I want to leave time for questions, but one kind of burning question I personally have is I want to know what you guys think is going to be the future of the real estate crowdfunding industry. I feel like, real estate crowdfunding in particular, as opposed to all the other different types of crowdfunding, tech crowdfunding or rewards-based crowdfunding, whatever, it's one industry that's really taken off. At the same time, the industry's been around for about 5, maybe 6 years. We've seen a lot of highs. We've also seen some lows, right? So for those of you who follow the industry closely, at the beginning of this year, Asset Avenue, which is an LA-based real estate crowdfunding platform, went under, and recently the East Coast-based iFunding went under. What are things that investors should think about the lifetime of a real estate crowdfunding platform, and how they can be protected against that? And what do you think, what do you really think is going to be the future of this industry? Not a nice question, I know.
Yeah, I mean, it's tough because, obviously no one knows what the future is going to hold, but it's also tough because it's still so early that we haven't really seen any huge problems yet where, regulations come down super strictly. Obviously, there's a lot of regulations starting out, and they're starting to get less stringent, making it easier for people to raise money. But to me, I think the future, it's just going to expand more, and there's going to be a lot more opportunities for everyone to invest in. And, maybe we'll see land development, fix and flips, things like that. And to me, I just see it kind of growing as a whole. Right now, it seems like crowdfunding is still a new concept to a lot of people, and they don't really know much about it. And so I think as it grows, you'll have more investors as well as more offerings. And I'm hoping a lot of the people who aren't transparent, the people who hide their fees in the little last text at the bottom of the last page, eventually fizzle out, and you can trust a lot of these bigger name brands that have been around for decades or at least a while and have a lot of track history.
And aside from hiding fees, I think one really important point of discussion is the fact that I think real estate crowdfunding platforms should charge fees, because otherwise, how are you going to keep the lights on, right? It's not a viable operation if there's no revenue coming in. So I think that's something I often hear. People are like, oh, why are they charging 1%? Why can't it be less? There's technology, right? Well, sometimes people don't work for free. But to continue.
Yeah, I think that individual investors are going to start getting access to bigger deals. We just wrote our largest check, or our largest investment ever, yesterday for a transaction, and it's really exciting because it's a big deal, and I think that you're going to start to see larger and larger deals, right? As we grow our investor base from 135,000 people to 300,000 people, we can now write check sizes 3 times the size, right? So that's what we're really excited about, is giving individual investors access to larger deals. Not to say that we haven't done large deals. We've done, tens of millions of dollars in a single deal size. But I think that doing even bigger transactions is going to be really, really exciting. And then I think it all comes back to people, right? So some of the issues that Amy was alluding to of these platforms were that they weren't charging. I have no qualms about sharing our fees. We have no qualms about telling you exactly what they are online. You know, we don't hide them, and we're really open about them because we do need to keep the lights on, right? We have 75 professionals at our company that are sourcing transactions and underwriting transactions and building technology, and we've built this really great, really big business. But at the end of the day, you want to look at who are the people that are around the table. What is their track record? Did they come out of banking? Did they come out of, you know, good schools, right? I mean, did they come out of good universities? It sounds silly, but you know, when I look to hire people in our company, one of the first questions I ask is, what was your high school GPA? People look at me like I'm nuts, and it's legitimately a question that we ask in our job applications because I want dedicated people at our company who have kind of this track record and this history of building great things and being really, really committed to hard work, right, and committed to dedication. And so people is going to be critical on the platforms that survive and those who don't. And you know, I think that this also goes back to why investing in cash flowing deals makes a lot of sense. People often ask us, you know, what happens if your company goes defunct? And at the end of the day, we have cash flow streams coming off of the majority of our properties that can pay and support those fees. So if there's a fee stream, you can put a trust company in to run those assets, right? To run those partnerships, if you will. So it's been a really important part of our strategy, which is sort of thinking about the worst case scenario, right? I used to work in risk management as well, so my head is just programmed this way, for better or worse. But those are the kinds of things that I think are really important to ask about at platforms and to get comfortable with the people at platforms.
Well, one of the things I'd like to just toss into the discussion is that because I deal with a lot of individual investors who are in charge of their own money, the enthusiasm is there. So I know that every burgeoning industry has bad actors and missteps and all that kind of stuff, but from an investor standpoint, and you guys probably know this, the enthusiasm is there. Shoot, you can get into deals today that you've been, you know, basically boxed out of for your entire life and for the lives of your parents and grandparents and all that stuff. So that part of it is incredibly exciting, and the enthusiasm is there. I often have somebody come to me and say, hey, if I wanted to do commercial real estate, or if I wanted to do this or that or the other thing, how do I do it? Now, my hands are tied in terms of mechanics, but I can give them some ways to go and start to research it and things like that. So I hope that we all make it through the transition period of, you know, a long-term industry. The other thing I'll just mention, and you guys have probably already noticed this from the way that they talk, the reason that these guys are successful is about the education part and reaching that person, so person to person. Because this is new, and describing the difference between Reg CF and Reg A+, I don't know how many times I've had to do that. It's a little difficult, right? And then I have to tell them about tax advantages, and then I have to tell them about the new paradigm of due diligence. So all of it is education. And so I think that when you are looking at a business, and hopefully one that will survive, again, the adolescence of this, it's who knows how to tell me what's going on? I mean, investors have good sense. If they don't get the explanation in a way that makes sense to them, we're not going to get them. So I know the enthusiasm is there, and education seems like such a huge piece, and I think people sometimes wall themselves off because they think they're already supposed to know the details of everything. I encourage all of us to ask all the questions until we've got them all found out, so that we know what we're doing, and then make the choice. But I do know that the enthusiasm is there. I'm hoping that will push, as you say, the folks who aren't going to make it, they die out, and the good guys stay around.
I would break this up into two parts. If you were to look at the regulatory environment, you know, what's going to happen on the Hill, and is that going to set us back? I would say that based on my experience, I actually worked on the Hill. Once you open up an opportunity for a whole new class of investors to access this market, real estate in particular, it's very hard to take that away. And if anything, the regulations in place, the hearings happening on the Hill, are leaning in favor of crowdfunding even more so today. So from a regulatory standpoint, I think everything seems pretty safe and secure. However, if you have those bad actors, people do things egregiously, steal money, etc., that's when they'll kick in, but they'll just make it safer to occur. Now, from the crowdfunding perspective, the companies out there, I agree with what everybody else has said, in that, you know, it's early, it's too early to tell, because a lot of the real estate transactions haven't come to fruition. They haven't completed, you know, their hold periods, and real estate's a long-term hold that's illiquid. But a lot of the companies out there doing it are not necessarily backed by institutions, or not necessarily, it's easy to deploy capital and they don't necessarily have the expertise to do so. So the companies, when some of these properties start to fail and investors get upset that they're losing money, I think you'll see where those companies quickly go out of business.
Got it. So we have about 11 minutes left for questions. Do you have any questions from the audience? Ooh, many hands. Okay. The gentleman with the striped blue shirt.
Matt, this is for you. As a self-storage investor, can you real briefly, the steps you went through to create your platform?
To repeat the question is directed to Matt, and the question is, Matt, how did you, what were the steps you took to go and create your own platform?
Sure. So we started out, my business partner and I, doing deals ourselves and syndicating deals through partners that we had already. So we were doing this offline, with connections we had made throughout our real estate careers. And as we started to grow, we kind of got more and more into the self-storage niche. It's kind of something, we had an investor, I think our first deal, we had an investor who was investing in self-storage and recommended it to us. We got into it. We really liked the asset class. And so we started paying more attention to it instead of the other asset classes we were in at the time. And so from there, it kind of just built up to the point where, we didn't have enough capital, just us two on our own. We thought, we'd go to the crowd to raise more capital, and that's kind of how we got to the point we're at now.
And then in terms of actually creating the platform, did you guys white label technology? What did you do for legal and all of that kind of stuff?
So yeah, there's definitely a lot of steps involved when you start in crowdfunding, more than I realized when I first started, that's for sure. And the first thing I definitely recommend is talking with an attorney, making sure you're doing everything the correct way. So we reached out actually on biggerpockets.com to find Trowbridge Sidoti, which is now Crowdfunding Lawyers. So they put together our offering. They were great. They helped us with a lot of the steps that you needed to do after that. But I think that's definitely the first step. And then obviously you need some way to show their investors what they're invested in. Some sort of CRM system where they can manage their investments and where you can relay information and things like that. So there's definitely a lot of steps involved. But I'd say an attorney is the first step, definitely.
Great. The gentleman in the white shirt.
Hi. What happens if there's a shortfall in equity, say halfway through a deal? How does that get funded?
The question is,
Single asset on a single asset.
on a single asset syndication, what happens if there's a shortfall in equity halfway through the deal?
Sure. I could take that. So what we do is we pre-fund the deal, where we close on the transaction, we write the check up front, and then we go back and raise the money and backfill it from the crowd. And our message is simple. If we come short on the raise, the transaction still goes through because we've already funded it, and the onus is on us. So it's pretty safe that the crowd investor who has come in, his investment or her investment will go through.
Yeah, we're very similar. We fund it on our balance sheet, and then we syndicate down to our investor base.
Cool. The woman in black?
Hi, my name's Neil Rockheim. Spent most of my career on Capitol Hill, was up there working on the Jobs Act. And my question is, I've heard you talk a lot about, there won't be changes to the Jobs Act because of the fact that people are pretty supportive of it, et cetera. And so I think the question is, there's pent-up energy on Capitol Hill and within the SEC. What recommendations do you have that you would give to Capitol Hill or to agencies that would improve your situation in terms of capital formation for the real estate industry?
I would love to give you my single biggest problem.
So I was just going to say to you, part of the major problem is that people on Capitol Hill want to do something, as well as the SEC, but they lack direction to know what to do. So I'd love to hear.
There's one thing that would be transformative that I don't know that anyone's talking about, and it's the Investment Company Act of 1940. So one of the exemptions in the Investment Company Act of 1940 is that you can't have more than 100 investors in an entity. It makes zero sense. I don't know what the difference is in risk when you go from 100 to 101, but it limits our ability to write bigger checks, which means that it limits our investors' ability to get access to larger transactions. And it's one of the reasons that we created our REIT, frankly, is because we wanted to be able to write larger checks. But it's a strange loophole in the Investment Company Act of 1940 that is our single biggest regulatory problem.
I just want to repeat the question for the audience and for the video.
Sorry, I was so excited.
No, it's okay. The question was, what regulatory changes would you make to the Jobs Act or otherwise that would help further capital formation? So anyone else have anything to add?
I couldn't agree more with Jillian. I think being 40 Act compliant is very difficult. It also means that you have to increase your minimums on larger transactions, and it's a hurdle that we would be doing much better and be opening up the doors a lot more without. But at the same time, I think if Capitol Hill were to go down and work more closely with the SEC to come over these hurdles and a lot of the filings as well, and a lot of the processes in between, and they were to work together, I think that would be enormously helpful to a more progressive future for all of us. I also think that a lot of what will happen in the future and what I fear is a lot of companies will go out of business because they've done things to show growth, but yet their investments aren't really that sound. And in turn, a lot of the regulations that will come will be reactionary. So I think if Capitol Hill could pay attention to what's occurring, seeing what's working, what's not working, and kind of predict some of the problems that may occur in the future and make it more strict, crowdfunding won't get a bad rap when things do go south.
I will also add in there that one of the regulatory experts on this whole thing is sitting right in front of you. His name is Andrew Dix. He's the editor of Crowdfund Insider, and we rant about this literally every other day. I know one thing that has been proposed, but I'm not sure seriously discussed, is the idea of a regulatory sandbox. The UK has it. Canada has it. We don't have it, and I think as a result, it's unfortunate for American fintech companies because we have less certainty and the ability for our fintech space to innovate. Any other questions out there? We have about a couple minutes left. Yes. So there were two questions. One was for sponsors, why use a real estate crowdfunding platform as opposed to just raising money yourself? And the second one was for investors, what's the advantage of going through, for example, a real estate crowdfunding Reg A Plus REIT offering as opposed to some publicly traded REIT that also provides liquidity and tradability?
I think if you want liquidity, you should invest in a public REIT, right? Which doesn't bode well for me because I don't operate a publicly traded REIT. But if you want liquidity, there's a no-brainer, right? You shouldn't be in real estate crowdfunding. This should be kind of the pocket of your capital, whether it's 10% or 20% that is really in illiquids. The benefit of a non-traded REIT is that you're not subject to stock market volatility, right? Stock market crashes, the underlying value of real estate does not crash that quickly. It can crash, but it typically doesn't crash overnight the way that your stock's going to be volatile. So if you want something that's less volatile, more steady stream, but not traded and not liquid, I think that typically you'll have an illiquidity premium, which means theoretically you should get paid more to be in an illiquid transaction than a liquid transaction. But if you need liquidity, right, if you need cash and you need it tomorrow, you shouldn't be investing in real estate crowdfunding, period. I think from the other side, if you're a real estate company and you're thinking about, do I use crowdfunding or do I go raise capital from my network of friends and family or otherwise, different platforms behave differently. In our case, I love this idea of collective bargaining. So what that means is that I make a single investment with the real estate company. Real estate company comes to us, we underwrite the transaction, and we are a single investor. That means that real estate company has to issue us one set of tax documents, one K-1, one distribution, one set of reports, and then we've built a bunch of technology to take that one report or that one tax document or that one distribution and divvy that up, 1,000 different which way to the investors on a pro rata basis that are invested with us. So it really streamlines the amount of overhead and the amount of work that a real estate company needs to do. That's the advantage for the real estate company. The advantage for the investor is that we get to collectively bargain for rights that we want because we're a majority investor or we're a larger, consolidated investor for the real estate company.
And to add to that a little bit, going back to the investor side, there's a lot of opportunities and different ways to get into crowdfunding. It's not just a non-traded REIT versus a public REIT in crowdfunding. With crowdfunding, there's you get rid of a lot of the middlemen and a lot of the other people involved in a REIT. So to me, one of the biggest advantages of crowdfunding is you're able to cut a lot of the fees and expenses and save both investors and the sponsors a lot of money. So to me, that's one of the best advantages you have. And then again, I think liquidity is huge, and then fluctuations. If you can handle that, a REIT might make sense if you need the cash quickly. But again, I don't think real estate in general is a good investment if you need liquidity. So,
Adam?
Yeah, I think from the publicly traded REIT standpoint as well, you don't get that insight on a property level and what investments are being made. It's really up to the company. In the crowdfunding model that we offer, you get actually more choice, and you get to actually own the property and get a return accordingly.
Great. Well, thank you so much for our panelists. Give them a round of applause.